For trust taxation, the first question is it a simple trust or a complex trust for this year? That classification drives whether income is pushed out to beneficiaries or can be trapped inside the trust. On the EA exam, they love questions where one small distribution or missed payout flips the trust status and changes who pays the tax. A simple trust has 3 strict requirements. 1. It must distribute all of its income currently, so no income accumulation. 2. It cannot distribute principal, meaning no corpus payouts. 3. It cannot make charitable distributions. Miss any one of these, and you're out of simple trust territory. Memorize these 3 like a checklist. A complex trust is basically anything that isn't simple. That means it can accumulate income, it can make discretionary income distributions, it can distribute principal, mandatory or discretionary, and it can give to charity. Exam tip: if you see principal distributions or charity, you can usually stop thinking and mark it complex for that year. Here's the twist they test. Classification can change year to year. A trust can be simple in one year and complex the next. The classic example is a trust that was required to distribute all income, but it fails to distribute it in the current year. That failure alone makes it complex for that year because income was accumulated. Now connect this to who files and who reports income. A revocable trust generally does not file a separate income tax return. Its income is attributed to the grantor and reported on the grantor's Form 1040. An irrevocable trust is a separate legal entity, and it files Form 1041 if its income is above the exemption amount. And it's the trustee's job to file, not the grantor's. Put it together for exam strategy. First, classify the trust for that year using the 3 simple trust rules. Second, watch for principal and charity keywords. Those scream complex. Third, don't assume the trust status is permanent. Finally, separate the filing concept. Revocable usually flows to the grantor. Irrevocable is its own taxpayer and may need Form 1041. The executor of a decedent's estate chooses the estate's accounting period based on which statement. Consider the choices. One says the estate must use a fiscal year tied to date of death. Another says the executor chooses calendar year or a fiscal year when filing the first return. Another claims calendar year is required unless IRS approval is obtained, and one ties it to the decedent's birth date. Think about it. The correct answer is, when filing its first return, the executor can choose the calendar year or choose a fiscal year. Estates are allowed to adopt either, and the election is effectively made on the first Form 1041 filed. A tempting wrong choice is the date of death forces a fiscal year idea. Date of death starts the estate, but it doesn't force the accounting period. Harrington died on April 10th and had income in respect of a decedent. Unpaid wages of $13,500, unpaid rent of $1,000, municipal bond interest of $750, and a short-term capital gain of $1,000 from a stock sale before death. His brother Ethan is the beneficiary and receives all amounts. How much is taxable to Ethan, and what's the character of that income? Think about it. The correct answer is $14,500 of ordinary income and $1,000 of short-term capital gain. IRD is taxable to whoever receives it, and it keeps its character. So wages plus rent are ordinary, and the stock gain stays a short-term capital gain. The muni bond interest is the trap. It remains tax-exempt, so you don't include the $750 in taxable income.